These are the tables that decide what your 80s will cost, what care you'll be offered, and what your insurance company already believes about how you're going to die. Most people who buy life insurance, long-term care coverage, or an annuity have never seen them, never heard their names, and have no idea how much of their financial future sits inside a spreadsheet built decades ago. I want to walk you through what these tables actually contain, who built them, what they predict about your 80s specifically, and why the numbers inside matter for anyone thinking about retirement, long-term care, or leaving something behind for family. Let me start with the basics, because the terminology trips people up. A mortality table tells an insurance company the probability that someone of a given age will die before their next birthday. Morbidity tables work differently, telling insurers how likely you are to get sick, become disabled, or need help with daily living, and for how long that situation will last. Mortality measures dying, and morbidity measures getting sick. Both shape the price of every policy sold to older Americans, and both rely on enormous data sets that quietly govern this entire industry. If you've ever wondered how a company can quote you a long-term care premium at age 65 and project what they'll be paying out when you turn 87, the answer lives inside these tables. Let me give you a sense of the numbers they work with. According to the Social Security Administration's most recent period life table, based on 2021 data, and published in the 2024 Trustees Report, a 65-year-old man can expect to live about 17 more years on average, while a 65-year-old woman can expect about 19.75 more years. By age 80, the average man has roughly 7.92 years remaining, and the average woman has 9.38 years ahead of her. Averages hide the real story, which is the spread. Out of every 100 American men who reach age 65, about 59 will make it to 80, around 39 will reach 85, roughly 19 will see 90, about 6 will make it to 95, and fewer than 1 in 100 will reach 100. For women starting at 65, about 70 will reach 80. 52 will reach 85, almost 31 will reach 90, and about 12 will see 95. Those are the odds insurance companies are pricing against. They know almost exactly how many of their 65-year-old policyholders will still be drawing benefits at 90. Now let me explain who actually builds these tables, because the names matter. The Society of Actuaries, founded in 1949, stands as the largest actuarial body in the world, and they publish the experience studies that underpin most life insurance and pension calculations in the United States. Founded all the way back in 1871, the National Association of Insurance Commissioners adopts the official mortality tables that state insurance regulators require companies to use. Over at the CDC, the National Center for Health Statistics publishes the country's official period life tables, and the Social Security Administration's Office of the Chief Actuary, currently led by Stephen Goss, produces the actuarial life tables that drive every Social Security projection. Across the Atlantic, an organization called the Continuous Mortality Investigation, or CMI, has been gathering insurance industry mortality data since 1924, and they celebrated their centenary in 2020. Their projections shape how British insurers price longevity risk. The history of all of this stretches back further than most people realize. Back in 1662, a London haberdasher named John Grount published the first mortality table built from real data, analyzing what were called the Bills of Mortality in London, and Carl Pearson later called him the father of modern statistics. Edmund Halley, the same Halley the comet is named after, published a life table in 1693 based on records from the city of Breslau. The Equitable Life Assurance Society was founded in London in 1762, becoming the first insurer to use mathematical mortality tables for pricing level premiums, and William Morgan, appointed actuary in 1775, is considered the first modern actuary. The level premium concept itself came from James Dodson, who died in 1757 before he could see his idea become an industry. These foundations, 3 and 4 centuries old, still form the architecture of how your premium gets calculated today. Let me move to the tables that matter right now. The 2017 CSO mortality table is almost certainly the one your life insurance policy is built on, assuming it was issued in the last several years. CSO stands for Commissioner Standard Ordinary. Adopted by the NAIC in December 2015, the table became optional starting January 2017 and mandatory on January 1, 2020, replacing the 2001 CSO table that had been built from data gathered in the 1990s. What's striking is the scale, because the 2017 table is built from $30.7 trillion of life insurance exposure, more than 5 times the data behind its predecessor. Insurers also use what's called a 25-year select period, meaning newly underwritten lives are treated as having lower mortality for 25 years before settling into the ultimate rates that apply to everyone of that age. For annuities, The relevant table is the 2012 Individual Annuity Mortality Basic Table, paired with something called Scale G2, mandatory for individual annuities issued on or after January 1, 2015. This was the first generational valuation table for individual annuities, meaning it builds in the assumption that mortality will keep improving over time. The table's terminal age is 120. Pensions have their own structure. On October 23, 2019, the Society of Actuaries published the pre-2012 tables, replacing the older RP 2014 tables. For public retirement plans like teachers and police officers, they published the Pub 2010 tables in January 2019, with an updated Pub 2016 report released on July 23rd. Layered on top of these base tables is something called a Mortality Improvement Scale. MP 2021, published in October 2021, is the most recent one released. Here's something interesting though, the Society of Actuaries did not release new MP scales in 2022, 2023, 2024, or 2025, because the pandemic distorted the data so badly that they switched to issuing annual update reports instead. That decision tells you something important about what COVID-19 did to this industry. Let me get into that, because it's one of the most dramatic stories in modern actuarial history. According to the American Council of Life Insurers, U.S. life insurance death benefit payouts in 2020 jumped 15.4% over the prior year, marking the largest year-over-year jump since the 1918 influenza pandemic. Payouts hit $90.43 billion in 2020 and then crossed $100 billion in 2021, the first time in history that line had ever been crossed. The Society of Actuaries ran a group life COVID-19 mortality survey covering April 2020 through March 2022, and mortality during that window ran 20.9% above the 2017 through 2019 baseline. Peak excess hit in the third quarter of 2021, when group life mortality among working-age adults reached 143.4% of baseline, meaning 43% above normal. Scott Davison, the CEO of One America, told an Indiana Chamber of Commerce event in December 2021 that death rates among working-age people on group life policies had climbed 40% in the third and fourth quarters of 2021 compared to pre-pandemic levels, calling it far beyond a 1 in 200-year catastrophe. For those of you 65 and older, the COVID numbers turned even more stark. According to CDC data, the COVID death rate for Americans 85 and older in 2020 reached 1,645 per 100,000, which came out to 2.8 times the rate for ages 75 to 84 and 7 times the rate for ages 65 to 74. Adults 65 and older accounted for 81% of all 2020 U.S. COVID deaths. U.S. life expectancy at birth dropped from 78.8 years in 2019 to 77 in 2020, then to 76.4 in 2021. It recovered to 78.4 in 2023, but that 2019 to 2021 decline was the largest two-year drop since the 90s. This is why the actuarial profession has been struggling to figure out what mortality looks like going forward. The data they normally rely on got distorted in ways they're still sorting through. Now let me get to the part that matters most for anyone watching this who's thinking about their 80s, which is the morbidity data. The Alzheimer's Association's 2024 and 2025 Facts and Figures reports give us a picture that long-term care insurers know intimately. Among Americans ages 65 to 74, about 5% have Alzheimer's dementia. The rate climbs to 13.2% among those 75 to 84, and among Americans 85 and older, the figure reaches 33.4%, which means 1 in 3. The Alzheimer's Association estimates 6.9 million Americans 65 and older were living with Alzheimer's in 2024, rising to 7.2 million in the 2025 update, and two-thirds of those affected are women. Measured from age 45, the lifetime risk of developing Alzheimer's runs 1 in 5 for women and 1 in 10 for men. Heart disease, stroke, and high blood pressure show up even more often. According to CDC data on adults 85 and older, 66.9% have hypertension, 28.3% have heart disease, and 13.3% have had a stroke. More than a third of Americans 85 and older carry 4 or more chronic conditions, and only 7.4% have none at all. Falls deserve their own moment. The CDC reports that more than 1 in 4 adults 65 and older falls every year. Among those 85 and older, more than 36% fall annually. In 2023, fatal falls claimed more than 41,000 Americans aged 65 and older, and the fall death rate for those 85 and older has more than doubled since 2003, reaching 339.5 per 100,000. Put this all together, and here's what the morbidity tables tell insurers. By age 85, the majority of Americans have hypertension, More than a third carry 4 or more chronic conditions. 1 in 3 has Alzheimer's, and more than 1 in 3 will fall each year. Roughly 20.7% of adults 85 and older need help with daily activities, which works out to 6 times the rate at ages 65 to 74. That's the population long-term care insurance was designed to cover, and the cost of that care is staggering. The Genworth and CareScout 2024 Cost of Care Survey reports that a private room in a nursing home runs $127,750 per year on average, with a semi-private room at $111,325. Assisted living comes in at around $70,800, and a home health aide costs about $77,800. According to research from the Urban Institute and the Department of Health and Human Services, 70% of adults who survive to age 65 develop severe long-term care needs before they die, and 48% receive paid long-term care services in their lifetime. Roughly 28% will spend 90 or more days in a nursing home, and about 15% will spend more than 2 years there. Total U.S. spending on long-term services and supports reached somewhere between $415 and $438 billion in 2020. Medicaid paid 61% of that. Out-of-pocket spending accounted for 17%, and private long-term care insurance paid less than 5%. This is where I have to tell you what happened to the long-term care insurance market, because it's one of the most important stories almost nobody talks about. Alliance Life stopped selling standalone long-term care insurance in 2009. November 2010 brought MetLife's exit. Berkshire and CNA followed in 2010 and 2011. In February 2012, Unum stopped group long-term care sales, and a month later, in March 2012, Prudential, the 5th largest individual carrier, quit. On November 10, 2016, John Hancock, the 2nd largest underwriter with roughly 1.2 million policyholders, announced its own exit. Before walking away, John Hancock pushed an 83% average rate increase on the federal long-term care insurance program in early 2000. New standalone long-term care policies sold annually collapsed from about 750,000 in 2000 to roughly 105,000 in 2015. By 2022, standalone sales had withered to just $124 million in premium, covering fewer than 37,000 lives. Cumulative rate increases on existing policies averaged around 112%, and thousands of increases have been approved. Genworth, one of the largest remaining carriers, faced class action litigation that ended in 2 major settlements. Scotian v. Genworth received final approval in November 2020 and produced roughly $213 million in cash damages plus alternative policy options, and Halcom v. Genworth received approval in June 2020. What replaced standalone long-term care insurance is something called a hybrid policy, combining life insurance with a long-term care benefit. According to LIMRA, combination life and long-term care products made up 20% of life insurance premium sales in 2022. Washington State took a different approach. In 2019, the state passed the LTSS Trust Act, creating the first state-run mandatory public long-term care program in the country. The 25.8% payroll tax began on July 1, 2023, and the lifetime benefit cap sits at $36,500. Now I want to walk through how insurance companies actually predict your 80s when you apply for a policy, because most people have no idea how much data gets pulled on them. The Medical Information Bureau, founded in 1902 and headquartered in Braintree, Massachusetts, sits at the center of all this. According to the Federal Trade Commission, MIB's members account for 99% of individual life insurance policies and 80% of all health and disability policies issued in the US and Canada. When you apply for life insurance, your application data flows into MIB's database, where it stays for 7 years. Insurers also pull your prescription drug history. 2 companies, Milliman IntelliScript and Exam1 ScriptCheck, dominate this market, providing 7 to 10 years of pharmacy history within seconds. LIMRA reports that 83% of insurers using accelerated underwriting rely on prescription data. Your motor vehicle record gets pulled too. A joint study by RGA and LexisNexis found that drivers with one major violation showed about 51% higher overall mortality than drivers with clean records. Credit-based insurance scores come into play as well. 3 main models lead the field: the FICO Insurance Score, LexisNexis Attract, and TransUnion TrueRisk Life, which was developed jointly with RGA Reinsurance and serves as the industry's leading credit-based mortality score. LIMRA reports that 3 out of 4 life insurers in the US and Canada now operate some form of automated or accelerated underwriting. Carriers planning to use accelerated underwriting jumped from 62% in 2019 to 91% by 2021. Average time to decision dropped from 27 days under traditional underwriting to just 9 days under accelerated. All of this is increasingly being fed into artificial intelligence and machine learning models. A NAIC survey of 161 life insurance companies in December 2023 found that 58% either use, plan to explore AI and machine learning models. This is where things get controversial. Your zip code ranks as one of the strongest predictors of how long you'll live. The CDC's USA LEP project produced life expectancy estimates for 67,148 census tracts. The NYU and Robert Wood Johnson Foundation City Health Dashboard found that 56 of the 500 largest U.S. cities contain neighborhoods more than 20 years apart in life expectancy. Chicago's gap stretches to 30.1 years, while Washington, D.C. and New York City each exceed 20. The Chetty study published in JAMA in 2016 looked at 1.4 billion tax records and roughly 7 million Social Security death records, and the researchers found that the life expectancy gap between the richest 1% of Americans and the poorest 1% reached 14.6 years for men and 10.1 years for women. Zip code correlates with race, income, environment, and healthcare access. When insurers use it, even indirectly through AI models, they're potentially encoding decades of historical inequality into pricing decisions. This is why Colorado passed Senate Bill 2169 in July 2021, becoming the first state to specifically prohibit insurers from using external data, algorithms, or predictive models in ways that unfairly discriminate by protected class. Regulation 10011, which applies to life insurers, took effect on November 14th. The NAIC adopted a model bulletin on the use of AI systems by insurers on December 4, 2023, and as of August 2025, 24 NAIC jurisdictions had adopted some version of it. The bulletin requires insurers to maintain written governance programs, oversee third-party AI vendors, and monitor for adverse consumer outcomes. New York's Department of Financial Services issued Circular Letter No. 1 in January 2019, and an expanded Circular Letter No. 7 in July 2024, requiring disparate impact assessments across all insurers. Then there's the question of genetic information. The Genetic Information Non-Discrimination Act, signed into law on May 21, 2008, prohibits health insurers and employers from using genetic test results. Here's the catch though. GINA does not apply to life insurance, long-term care insurance, or disability insurance. Florida partially closed that gap when House Bill 1189, signed by Governor DeSantis and effective July 2020, made Florida the first state to ban life, long-term care, and disability insurers from using genetic information. Before I wrap up, I want to mention one more piece of the industry's history that most people don't know. From the late 1800s through the early 1970s, the largest U.S. life insurers, including MetLife, Prudential, and John Hancock, routinely charged Black Americans higher premiums for industrial life insurance policies. Frederick Hoffman of Prudential published a document in 1896 titled Race, Traits, and Tendencies of the American Negro that provided the actuarial justification. Decades later, this practice resulted in settlements. MetLife set aside $250 million in reserves for race-based policies sold between 1901. American General agreed in June 2000 to $206 million in restitution. Prudential made charitable payments to the United Negro College Fund and the NAACP Legal Defense Fund, along with individual restitution. The history of how insurance companies decide what to charge people is not separate from the history of how Americans have been classified and sorted. It's the same history. Let me bring this back to where I started. The morbidity and mortality tables I've described form the architecture behind nearly every policy that touches your retirement years. They determine what your long-term care premium costs, what your annuity pays, how much your life insurance will leave behind, and how insurers think about your 80s before you've even applied for coverage. The numbers in those tables come from real Americans. The 2017 CSO drew on $30.7 trillion of insured lives. The pre-2012 tables were built from 16.1 million life years and 343,000 deaths, and the Pub 2010 tables came from 46 million life years and 580,000 deaths. Every premium quote is, in some sense, a calculation built from the lives of people who came before you. What's changed in the last decade is that these traditional actuarial tables are now layered with prescription histories, credit data, motor vehicle records, zip code level patterns, and increasingly artificial intelligence models. The 70% of Americans who will need significant long-term care, the 1 in 3 who will develop Alzheimer's by age 85, the 41,000 a year who die from falls, all of them show up in someone's spreadsheet years before they show up in their own lives. If you're thinking about long-term care coverage, life insurance, or an annuity, understanding that you're being priced against these tables is the first step. Reading your policy carefully, asking what data sources were used, and knowing your rights under state laws, like Colorado's SB 21. The insurance industry has been predicting your 80s since the day you were born. The least we can do is understand how.